Right, thank you very much for attending, everybody. This is our How Do You Trade CFDs webinar. Now, one thing I wanted to just say right up front is that I did hold a similar webinar on how to trade, how to spread bet very recently. So overall, the way I'd characterize these two products is that they are pretty much very similar products. We're looking at variations on the same product. I would go so far as to say that. And so as a result, a lot of the material from this webinar is going to be very similar to that of the How to Spread Bet webinar. So I just want to put that out there up front. For anyone who's watched that webinar, you're going to be seeing a lot of the similar material. Obviously, more than happy for you to stick around, and if there are some specific questions you have on CFDs, hopefully I'll cover it anyway, but if not, please just ask questions and I'm happy to answer those. And then obviously probably the main difference will be towards the end of this. If you are watching the recording of this, then you can even jump ahead maybe towards the end. It's only going to be a 30-minute webinar, so maybe you can just spare the time, but towards the end we're going to go through an example trade which will be a little bit different to the spread bet. So I'm assuming everyone's had a chance to read through the good old risk warning on the screen here. I'm going to blast through that. This is what we're covering today. What are CFDs? The advantages and disadvantages. How does CFD trading work? How much does it cost? And an example trade at the end. So obviously all these are pretty, these are all questions that you basically really need to know the answer to before you start trading this product. There are a lot of advantages, but we're going to try and be balanced here. We're going to state some of the disadvantages, but you really need to know. So, I mean, the way I'd characterize the reason for this webinar is that trading it can be a tough old game. There's a lot of money to be won here, but for that reason, it's a good challenge. And so there are enough challenges in trading without you causing yourself problems that are unnecessary by just not even knowing the true nature of the product that you're trading and just some of the details that are key to know before you get going. I think you'll see in this webinar that actually CFD is a very simple product to use. There's just a few details to know before you get stuck in. And obviously that's why we have demo accounts to really put it all into practice. There are different kinds of trading accounts to have. You don't have to CFDs. Of course, you can spread bet, which I mentioned if you're in the UK. But there are regular share trading accounts. There are futures accounts. So you've got options when you're trading. So I'll try and touch on a little bit as to why CFDs tends to be a good option, and why sometimes it may not be. So very simply, it's a way to trade the market, to trade on future price movement of financial markets. CFD stands for contract for difference. So a client enters a contract, that's where the contract comes in, with a broker, obviously in our case LCG, to trade the difference between market prices at different points in time. So again, I'm going to go into more example trades on this, but it's more like an agreement, a contract between you and your broker to trade back and forth in the prices of a certain market without actually buying or selling that physical asset or security of that underlying market. Now, a nice thing about it is that you can define your own odds. This is not like this is investing. It's trading. It's not gambling. So when you're looking at some other kind of products that you can trade on markets, binary options, for example, the odds are a bit more defined, and so it's more of a kind of win-lose outcome. In trading, it's more about tilting the odds in your favor over a period of time, because you can define how many points you try and win in a trade, how many points it takes before you cut out at a loss, and that by itself can define your kind of expected win versus expected loss over a number of trades. And that's what people, when you have a strategy that gives you more wins than losses or bigger wins than losses over time, then that's your edge. Now again, try and reiterate this point that we're trading here. The whole point of this is not to own a piece of Microsoft because you think it's a great company. Purely trading here to try and make trading profits. So we're not owning anything, just trading on the price movement. Now one of the really prime advantages of trading CFDs is that you can go long the market or short the market. So if you think the market is going up, you can go long, so you can buy low and hopefully sell high at a profit. Or if you think the market will fall, you can actually sell at the top of the market and hopefully the market drops as you suspect and you buy it back again at a cheaper price. Now the cost is the same for going long and short. So obviously we're in a raging bull market in stock markets at the moment. I've got it on my screen at the moment. I can pop it up and show you. I'll get back to it in a minute. This is our market for Wall Street, the Dow Jones. You can see we just hit 23,000 in Wall Street for the first time. So we're in and look at this market, just rage into the top side. A really strong market for trading at the moment. If you're of the opinion that the trend is your friend, you're going to be buying into that trend. But equally, if you think, wow, valuations are just way excessive at the moment, this bull market is getting pretty frothy, I want to sell Wall Street, you can do so just as easily. Now, there's 24 hours trading a day. It depends on the product specifically involved. Now, Forex, like currencies, are 24 hours. Some of the indices more closely track the exchange hours of the specific underlying indices, like the trading on the UK 100 is more aligned to kind of UK London trading hours, but it does extend before and after. So you can trade beyond the regular trading day, which is a great advantage. You can use leverage. Now you'll note that I've listed here this as an advantage, but also as a disadvantage. Now this is the advantage of it. It allows you to place bigger trades using less capital. So again, I'm going to go over the disadvantage factor of this in just a minute. But the big point here is it's a really big reduction in the barrier to entry to new traders. If you're new to the market, you know, obviously the amount of money that you put in, it depends on your own unique scenario. If you're a multimillionaire, then you know you're not going to really care about the result of the trades, I think, if you have much less than 6 figures in your account. But you know, for the vast bulk of us, we don't want to be putting large proportions of our wealth into a trading account, nor should we be when we're still getting familiar with the product. We want to start with smaller amounts of money, but in some places that prohibits you from actually trading. So if you want wanting to buy a share that is worth if you wanted to buy a share that's worth $1,000, but you only have $1,000 in your account, then obviously that's quite restrictive because you know you're literally buying just one share with all your money. It's not a very diversified portfolio. You can't place other trades. Whereas you know with leverage, you know perhaps if you have 10-to-1 leverage, then if the value of that share is $1,000, you can actually just put up $100 for that trade and use that remaining $900 for other trades or for other purposes. Now the other advantage is that you can trade on multiple markets all under one roof. So you don't need one account for commodities, one account for Forex, one account for Bitcoin. You know, you can literally do everything under one roof. So that just obviously really makes things a lot more convenient. And as I showed actually as an example just before we started recording, actually I'll try and show it again. It's very easy for you to open multiple accounts within this, you know, this one bracket of accounts, if you like, in the case of LCG. Now, a nice one for the UK specifically is that there's no stamp duty on earnings from CFDs. So you've got to, you know, much of people's financial planning is about optimizing how much tax you pay. I'm sure you all know that. So when you've got to consider the fact that CFDs has a certain tax advantage here in terms of no stamp duty. Now, my understanding is that that's a similar scenario in most international countries, but international clients should check the tax treatment of CFDs. And I should mention that, of course, I'm not a tax expert. Tax laws are subject to change and depend on individual circumstances. So again, so we're switching gears to the disadvantages here. Again, back to leverage. Obviously in that scenario that I gave, where you could just bet $100 and place a trade for $1,000. If you think about what would happen now, if the value of that share went up by $100, so if it went up by 10%, if you've just put up $100 and the value of the shares that you're buying have gone up by $100, you've just doubled your money. So you can see here that's powerful. But the flip side of that is if the shares drop by 10%, you've just lost your whole investment. So do you see how that works? That's obviously pros and cons here. Greater potential returns, but at the expense of greater risk. And so, that's why we encourage everyone to learn about risk management when getting into this kind of trading. And we will, in fact, be doing a separate webinar specifically dedicated to ways to manage the risk on trades. Now, back to that point about ownership. The good thing is that, you don't need to bother around with share certificates or anything. I mean, things are pretty digital these days, but you don't own anything. So there's no responsibility there. That's a plus. But the downside is when, in the case of equities, you don't have any voting rights or influence over the markets you're trading. That's more of an issue, I would say, for much larger traders when you're placing really big bets that would influence the price. Not such an issue for smaller traders where really the size of your trades is a splash in the ocean anyway. And one thing to note is that you still earn dividends when you're trading CFDs, but only when you're long, i.e. buying. Makes sense, right? You're not going to get dividends for shorting a company, for betting the shares go down. Capital gains tax. UK clients will pay capital gains on any earnings from CFDs. So it's a quick mention here that obviously spread betting has a tax advantage over CFDs from that standpoint in the UK. But of course, again, not getting into the realms of tax advice here. I'm not a tax expert, but the flip side of that is if you do have some losses, then you can offset that against other investment winnings. So pros and cons. International clients, again, should probably check the tax treatment of CFDs, but my understanding is that most of the time you are paying capital gains, like any other investment, really. And, of course, tax laws are subject to change and depend on individual circumstances. So how does trading CFDs work? The crux of it is that how much money you win or lose depends on two things. A, if the market moves in your favor. B, how far the market moves. So obviously if it moves in your favor, you're going to be winning pretty much. If it moves against you, you're going to be losing. But then if it moves for you and a long distance, you're making a big profit. And if it moves for you but only a small distance, you're making a small profit. Vice versa for losses. So this is obviously the art of the game, right? The aim is to pick the right direction of the market and ride that price move for as long as you can. And again, we'll get into risk management, all different strategies, and that's something for another webinar. There's only so much we can cover here in half an hour. This is more of an introductory thing, but you really want to be aiming for scenarios where you're looking to win more in your trades than you lose. So having a good risk to reward ratio is key. So cutting your losses when they're small and riding the profits. Obviously, everyone's natural instinct is to ride out larger losses and cut the losses quick. Cut the winners quick. Pocket the money while it's there. But oh no, the market will turn around when it drops. That's obviously the psychology of of trading, and it's a once you've overcome that, you're really on a big step towards success in trading CFDs and indeed other trading. A quick one on what is the spread. So the spread is the difference. So there's always a spread in any market you trade. It's just a bit more clear-cut in CFDs because that's your only cost of trading. The difference between the buy and the sell price. Now, when you're buying shares in a, I don't want to mention specific company names, but you're always going to be buying at the ask price. You're always going to be selling at the bid price. So when you buy shares and you make a profit on your shares and you sell them, there's going to be a few points that you lose because you're paying that spread to someone who's making the market. That exists everywhere. The only difference there is that you're paying an extra commission to the broker you work with. In our situation, we are your broker, we are your market maker, all put together in one. Hence, we just need to charge the spread, not the commission bit. So CFDs are derivatives. Can be a bit of a scary word to some, but really actually in the case of CFDs, very simple. The price that you're trading is just derived from an underlying market. So an example of an underlying market is BP shares trading on the London Stock Exchange. You can trade BP with LCG, but you're not buying the shares. You're buying something that's derived from the price of BP shares, which trade on the London Stock Exchange. So, as I mentioned earlier, LCG makes a market by offering you a buy and sell price. When you buy, use the ask. When you sell, use the bid price. So the way to remember which is you always get the worst price. Makes sense, right? You're basically always going to have to buy that higher price and sell that lower price of the two. And yeah, just a quick reminder that going long is buying a market, going short is selling a market. So in terms of cost, typically a lower cost than traditional trading accounts because again, you're not paying that commission and the spreads are normally pretty tight. There is a rollover interest which can be a big consideration if you're someone who's planning on a very long-term investment. That rollover interest can start to eat into your profits and can be a consideration as to why to maybe use other forms of trading. For the most part, this is a trading account. You're looking to buy and sell on a fairly regular interval, and it's not such a factor. And I would argue most of the time, the no commission and low spreads offset it. So to go over this, the overall cost of the trade, your trade, depends on the spread, the position size, so how big your trade is, and how long the trade is left open, and that goes back to this rollover idea. So these are kind of three considerations you need to make for how much your trade is going to cost you, right? Nothing's for free, trading's not for free, there is a cost of doing it, so that, work it out beforehand and make sure it's acceptable to you. So just as a quick reminder, the spread is the difference between the buy and the sell price. When you're trading CFDs, the spreads do fluctuate depending on market conditions, so they are variable spreads. That's normal. That's just how markets operate. And sometimes you can get fixed spreads, but oftentimes if you get a fixed spread, the execution on trades won't necessarily be as good. The reason for that is that spreads will be tighter when markets are more active. So at the open and close of equity markets, typically spreads are very tight. Generally during the London trading session, they're tighter than, say, the Asian trading session, where there's just not as much volume of trading. And then right before news events, everyone will obviously stop trading because some new information about the market is about to hit and affect what people price that asset as. Is going to be determined by this news that's about to come out. So suddenly the amount of trading completely drops off before a news event. So hence the spreads widen because the difference between the buyer who's willing to buy at the highest price and the seller that's been willing to sell at the lowest price, the difference between those two extreme participants in the market is just that much wider. And so it's unnatural for that not to be the case in terms of like a fixed spread. And so what can happen is if suddenly you're in a situation where you're trying to pay a fixed tight spread in an environment where the spreads should naturally be wider, sometimes you just won't be able to get into a trade. Ruben, I appreciate your question on time frames in terms of which it's best to trade on CFDs. It's going to be, so Ruben's just asked which time frame is usually best to trade CFDs. It's going to be a very evasive answer as usual, Ruben, as you probably would have guessed. It really does depend on your own tolerance for risk and the amount of time that you have available to trade. I'm in the privileged situation where I get to see, get to encounter a lot of traders, and there are people making money with all sorts of different strategies here. People placing 100 trades a day are making money. People placing a trade once a month and making money. So it's almost impossible to say. I can only say that for my own personal preference, because I'm an analyst by job, I can't actually spend the day trading. My preference is to use a daily time frame for my trade triggers. So that leaves you typically in a trade for anywhere from a few days to maybe a couple of weeks at extremes. That's not a really long-term investing time frame. That's more of a kind of swing trading, position trading type time frame. But obviously, if you're day trading, then you're looking at more like 15-minute, 60-minute charts. If you have a day job, it's tricky to day trade because you sort of need to be there during the day. But again, it goes back to the advantage of this is a 24-hour market, so there are always times you can day trade outside your office hours. So you can day trade US stocks, which are still open after we finish work in Europe, or you could get up early and trade Asian forex currencies, so the Japanese yen, etc., before you go to work in the morning. So there's a lot of flexibility here, and so which your preference is. Do you want to just be in the evenings and looking at kind of longer term trades over the next few days, or do you want to be short-term trading in the evenings and the mornings? It's a personal preference, and a lot of the time you have to kind of think about your own personality and what would really suit you, and then try and see if it works for you. Getting back to position size here, this is just another element of how much does the trade cost. The position side affects you in this kind of trading. Say if you're paying a fixed commission, right? If it's just £15 to get into the trade, £15 to close the trade, like would be maybe a typical commission on a trade. That obviously is just fixed. When it comes to the spread, it depends on how big your trade is. So if the spread, for example, is 1 point, you could hold a position size where the value of each point is £1 or $1, whatever currency you want to use in this example. And so if you hold a bigger position size, the value of each point is going to be £100, and so the spread is in points. It's not in fixed amounts of currency, it's in points. So because you're making £100 each point on a bigger trade, the spread is also going to be £100, not £1 when it would be when you're trading £1 per point. And this last point, again, rollover interest, also referred to as swap financing or funding. Rollover interest is charged for holding a trade overnight. So as I mentioned here, rollover interest will not be incurred if the trade is opened and closed within the same day. So day trade is not a consideration here. If you are holding trades for multiple weeks, months, then obviously this is more of a consideration, and it's worth calculating how much you're going to be earning here. In Forex, it can be a big consideration as a positive because if you're buying a higher yielding currency, a currency which has higher interest rates, typically the Australian dollar, for example, has higher interest rates than the US or the UK or Europe, and so typically when you're buying the Aussie, you're earning spread versus if you were buying the euro, your interest rates are on the floor, so you're typically paying. And just the reason for this is that financial contracts traded in financial markets, they typically close at the end of the day, so interest is levied in order to roll over the trade to the next day. So you're basically almost starting a new contract, if you like, but obviously we're not putting you through the broker is not putting you through the hassle of having to reopen a new contract, close a trade and reopen a new one. It's just rolling over that same one. But there is a process going on behind the scenes which takes a bit of time and money, and you have to factor in changes in short-term interest rates as well. So all that baked in makes the rollover cost. And so here we are, we're getting to the live example trade. This example will cover placing a trade, changing the size of your position, calculating the spread, calculating the rollover, how to work out potential profits, how to limit potential loss, and entering a long and short position. Right, so this is our LCG trader. Let's get it into full screen. There we go. So yeah, again, we've got good old Wall Street ripping on us, still record highs as we speak. Best place to start for me, you generally when you open up the platform, you're going to look at something pretty similar to this. It's going to have the watch list typically on the left and maybe one or two or several charts. I am doing a separate webinar on how to use the LCG trader, so I'm going to really go through all the different ways you can use the platform. So I'm not going to repeat myself in this webinar. I'm more talking about just specifically how the CFDs work, not just in this platform but in any platform. So take the example of Wall Street. What we can do here is just click anywhere on Wall Street and you'll see this little area comes up here, and then equally this area on the right will pop up as well to give you a bit of information on the market. So what we're looking at, sell and buy buttons obviously. If you want to buy Wall Street, you expect a new record highs, you're buying at 23,087. If you're selling, you can see you're selling at 23,085. So that the difference between 5 and 7 is obviously 2, and here you can see the spread is 2 points. So you know that's really what's telling you your spread here, and then this little bit in the middle is how many lots you want to trade. So what does a lot mean? What you want to it means universally one thing, but it's each contract has a slight variation on what a lot is. So there is that little short box that pops up when you hover over, but I like to just click on this information button. It gives you all the information right here, and you can see that a lot size is 10 times the index. So in the case of Wall Street, 0.1 is basically you're buying a contract worth $23,000, $23,883 is 0.1. 0.1 of a lot. So obviously it's a tenth the size of a lot, because one lot is 10 of the index. So one lot, if we go and change it here to one lot, we're now buying or selling a contract worth 230,000 US dollars. So obviously if you've got your account based in dollars and you're buying and selling Wall Street, again if I go back to the information tab here, remember that this is quoted in US dollars. If your account's in dollars, then obviously no real extra thought process needed here, right? If your account is in something else, euros or pounds, then you just have to make the calculation for yourself. Well, I'm buying a contract that's worth maybe $230,000. You have to just use the spot rate for the euro dollar to get that into your euro currency, to know the size of the trade that you're placing. Now, each and again, here's the market hours of Wall Street. So you can see it's pretty much 24-hour trading in Wall Street. It's one of the most active markets in the world. It's obviously the world kind of most famous equity benchmark that you can trade. But there's a lot of information here. This is where it's, you know, where I mentioned the rollover cost. Here it is, funding long, funding short. So this is the value of what you would have to pay each night that you hold a trade in Wall Street. So you're going to pay 1.9675 times the value of one lot for you. So times the value of 1 point. So what you can, so what is a unit risk here? What is a point? Well, it's just literally $1. So to put it simply, if you're trading, if I close that down, if you're trading 0.1 lots, where basically the value of the contract that you're buying is 23,000, then if if Wall Street goes up from 82 to 83, from 23,082 up to 23,083, then you're making $1, and then obviously you translate it into your local currency. If you're buying one lot, then if Wall Street goes up by 23,082 to 23,083, then you're making $10. So yeah, good point. Yeah, exactly, Mike. You need 23,800 to buy 0.1 of a contract. But obviously, going back to the good thing about trading in CFDs is that you have leverage available. And so I believe it, does it show it in this tab here? Oh yes, it does. So down the bottom here it says leverage, and so from 0 to 1 million in volume, so obviously when we're talking about 23,000, it's obviously well below 1 million, then you have leverage of 500 to 1. So what that means is, instead of putting up 23,000 at an absolute bare minimum, you need to put up 23,000 divided by 500. Which I wish my maths was better off the top of my head. Should we do a little? Should we pull up a little calculator? Let's do that if I can. I'm sure there'll be 46. Boom. Mike's already there. He's one step ahead. For those who might be doing this a bit when you're first working out your contracts, yeah, 23,000, say, divided by 500. 46. So suddenly buying a rather large contract has become a lot more affordable. Now something you've got to caution here is you can't just put $46 in your account, because the market just has to move one tick against you and suddenly you'll be out of your position. You'll be left pretty much with your $46, but you'll be out of a trade and you'll have paid the spread needlessly. So you obviously want to have be aware of that bare minimum requirement, but of course have extra money on top of that to allow for fluctuations in the market. So I gave the example of Wall Street here. Obviously the UK 100 is our FTSE 100 here in the UK. And you can here see it in that summary, you saw it there, and I'll pick on the I tab here, GBP. It's in Great British Pounds. So if your account's based in pounds, easy obviously. If your account's based in dollars, then obviously you need to look at the fact that it's 10 times the index again. Each point is worth £1 when you're trading 0.1 of a contract, or 0.01 rather in this case, then you obviously need to factor that in to your kind of trading style, and factor in, in terms of your currency. You just need to do that kind of conversion. So jumping back to the webinar here, we've not actually placed a trade yet, but I've talked about changing the size of this and talked about this spread, rollover, and the next thing to cover is potential profit and potential loss, and entering a long and short, which we have basically covered. So if I press a trade here, let's we're getting a bit of a dip, it looks like. We'll just hit the big 23,000 mark. You know, maybe that's a big psychological number that's it's getting people worried. Should we sell it? Risky, right? Massive record-breaking bull market. It's only a demo account, luckily. So let's choose to sell Wall Street. When the first time you do this in your trading account, good bit of flexibility here. What this just means is that you could have it set up so that if you just click sell, that's it. You're straight into a sell trade of 0.01 lots. What I personally prefer is a double click. So who knows, the cat treads on the mouse, or you accidentally click on the wrong instrument. A bit more thought process involved if you have the double click set on, or you can have it disabled, so you won't actually automatically enter into a trade whether you single or double click. You'll bring up a order panel. That's an even more conservative approach. So then you click OK to that, and then here we go. So we're on the UK 100. So euro is up, euro dollar is up here. You know, maybe we're putting in a bit of a bottom here, and a couple of kind of spike lows here in the euro dollar. Maybe signs of a base. I haven't really put that in the context of it. Yeah, potentially. So maybe there's a little rally taking place in the euro dollar. We could go for that. And you see I've got two little green clicks there, and I've just double clicked, and now I'm into the trade. Now what you can do, and again this is something that I'm going to cover more in detail in the actual LCG Trader walkthrough webinar, but there's all sorts of things you can do in order to minimize your risk, and you can use different order types like a stop loss or a take profit order. But the general concept here is that, say we're looking for a little rally off the base here, like the market's been declining, and we think maybe it's bottoming out in the case of this euro. We've had a couple of bases here in this sort of 117.30 area. So maybe the idea that we've got with this trade is that if the market dips back down through this low, then the basis of our idea that actually the market's up, trying to rally, 117.30, we're at 117.50, so we're risking 20 points here. That could be our risk. So we just risk 20 points. We decide how many contracts we want to buy or sell on. So in the case of currencies, I've been using the example of indices. What we'd be doing here is buying or selling 1,000 euro. I think that's what I bought, wasn't it? Was it 1,000. You can see your size here in under your positions tab. Is you bought 1,000 euros. So each little incremental change of which in currencies terms is known as a pip, you're going to be making, in my case, since my account's in dollars, 10 cents for every little fourth decimal place movement you get in the market. So maybe I can up the ante to 10,000 euro or even 100,000 euro. In the case of 100,000 euro, each fourth decimal place point movement here, so 1747, each one of those moves, you'd be making and losing $10. That's if it's a 100k size contract. If it's 10k contract, it's 10. It'd be $1 up or down. A 1k contract, it's just 1 cent up or down. So in my very small trade that I placed here, basically be risking a fairly small amount of money, just 20 points. And then what you could say is that I'm actually expecting it to rally up here and maybe test some big round number at the top. So maybe I think it's going to go back and rally up and test a round number like 18,000. So it's a nice trade scenario from the sense that you're only risking 20, 117.30 to 50, but you're aiming to make 50. So again, if the market drops, you've lost 20, but if the market rallies up to where you hoped, then you're making 50. So this is a way to kind of pre-plan your trade so that you're not just suddenly risking all your account on every trade. You actually got a defined risk in mind about how much you want to win or lose. So first think about the number of points, then you think about how much money is in your account, and you think how much of your money are you prepared to risk, and from there you decide on the size of the contract that you want to trade. And then one quick last thing to mention is, well, how do you see how much you've paid on a trade? In the case of, I know I'm jumping around instruments here, but we do have a lot on offer in terms of different markets to trade. You can see here the spread's variable, it's jumping around a bit. I think what I probably paid was 0.5 on euro dollar, and so pretty much the trade is unchanged. I'm just down 10 cents, so 5 points. Did I say a cent a point? I'm sorry if I'm being confusing. It's 10 cents a point for a 0.1 for a 1K contract. So you start down the amount of your spread. So if your spread is 5 pips, 0.5 pips, then you start down that 50 cents. You have to recoup that 50 cent spread, and then everything else on top will be profit. So that's why you always start down at a small loss, because you basically just paid the spread up front. And that's your only cost of trade. When you close a trade, there's no extra spread to be paid. It's already been factored in at the start through this loss amount. So yeah, important point to note, you only pay the spread once. So I think that's about it, guys. Not the place to get too in depth, but I'm hoping over a series of these webinars you're going to get a pretty good grip on CFD trading and the different options available. The next webinar we have planned is a full walkthrough, in essence, of the trading platforms. Please check that one out if you can. Thank you very much, everyone, for attending. Really appreciate your contributions here and the questions, and good luck trading for the rest of the day. I guess the only next options from this point are, if you've not already done so, open a demo trading account at this address, or you can indeed open a live trading account at the address below. Thanks again, everyone. Jasper signing out. Have a great afternoon.